As the market opens, Applied Digital, ticker APLD, is trading at $35.26, up about 1.7% in the first few minutes of the session. This move comes after closing out last week at $34.66. The immediate surface-level assumption is that this is just the stock's usual volatility tethered to the whims of the crypto markets. But the reality is, the market is fundamentally mispricing this company, and the opening jump today has very little to do with Gitcoin. The real story is about a massive $5 billion contract announced just days ago, and the market's slow, agonizing, and incomplete process of reevaluating this company from the ground up. What we are witnessing isn't a crypto stock's speculative pop, it's the institutional realization that APLD is no longer what they thought it was, and it's happening in real time. This is a crucial moment for anyone watching this name, whether you're trading it actively on a platform like Interactive Brokers or just monitoring it for a long-term online investment thesis. The common belief, the narrative that has defined APLD for the last 2 years, is that it's a simple, high-beta crypto mining proxy. It's the stock you buy on the Robinhood app when you want leveraged exposure to a Bitcoin rally. The expectation is that its revenue is entirely dependent on the fluctuating and often maddening price of digital assets. This is the company that, in the market's mind, just builds sheds with cheap power for crypto miners. This expectation has kept many serious investors, the kind who build their core holdings with Fidelity ETFs or Schwab Intelligent Portfolios, far away, branding it as too speculative and untethered from real-world fundamentals. They see its wild chart, with a 52-week range stretching from a little over $3 to over $40, and see a trader's plaything, not a serious investment. But here is the reality that completely dismantles that expectation. Applied Digital has been in the middle of one of the most significant business pivots on the entire market, and the market is only just now being forced to acknowledge it. The crypto miner label is a ghost. The reality is, APLD is aggressively transforming itself into a high-performance computing, or HPC, data center provider aimed squarely at the insatiable demand from the artificial intelligence sector. This isn't about Bitcoin. It's about providing the essential, power-hungry infrastructure for AI models, a business that has much more in common with the demand drivers for NVIDIA stock than it does with a crypto exchange. The company's recent announcements are not just minor news items, they are foundational events. On October 22nd, APLD announced a massive $5 billion lease agreement with a US-based investment-grade hyperscaler, that's code for a tech giant like Google, Amazon, or Microsoft, to build out a 200-megawatt AI factory. Just 5 days later, on October 27th, the company announced it had achieved ready-for-service status for the first phase of its facility for CoreWeave, another massive AI infrastructure client. This is the reality. The market is pricing a crypto miner, but the company is signing contracts like an AI infrastructure stalwart. This discrepancy is why the recent stock movement has been so explosive and, to the uninformed, so confusing. Let's look at the tape. The stock hit its 52-week high of $40.20 back on October 16th. This was the climax of a massive run-up that started in early October, precisely when the company reported its fiscal first quarter 2026 results. Those results, reported on October 9th, were the first major crack in the old narrative. The company announced revenue of $64.2 million, smashing expectations of $50.97 million. More importantly, its adjusted earnings per share came in at a loss of only 3 cents, vastly better than the 14-cent loss analysts had priced in. This was the proof. The new HPC business was not just talk, it was generating real, better-than-expected top-line growth and dramatically improving the bottom line. The stock exploded from $29 to $40 in a matter of days. Since that peak, the stock has been in a period of intense, high-volume consolidation, trading in a range roughly between $33 and $37. We are seeing daily volumes consistently clearing 30 million shares. This is not retail trader noise. This is institutional accumulation and distribution. This is a battleground where large funds, who may have held the stock as a crypto play, are selling to new long-term tech and infrastructure funds who are buying it for its AI future. This price action is the definition of a stock finding a new identity and a new, higher quality investor base. This is the kind of self-investing play that requires you to read the press releases, not just the charts. For those who are new to the story, let's briefly clarify what Applied Digital actually does. The company, which was indeed formerly known as Applied Blockchain, has two main segments. The first is its legacy data center hosting business. This is where the crypto narrative comes from. They build and operate facilities, primarily in North Dakota, and lease that space and power to crypto miners. This has been good, but highly volatile source of revenue. The second and far more important segment is its AI cloud services and HPC hosting segment. This is the future. This segment builds specialized next-generation data centers designed for the immense computational needs of AI. These are not simple warehouses. They are complex facilities with advanced cooling and power management built to house tens of thousands of GPUs from companies like NVIDIA. The contracts are different too. Instead of being short-term and tied to crypto prices, they are long-term, often 10 to 15 years, with investment-grade tenants. This provides stable, predictable, reoccurring revenue, the kind of revenue that would normally make it a candidate for a conservative wealth management portfolio at Fidelity, not a speculative watch list on Robinhood. Looking forward, the entire thesis for APLD rests on this transformation. The catalysts are no longer about the price of Bitcoin. The primary catalyst is execution. The market has seen the $5 billion hyperscaler announcement, but now it needs to see the facility built on time and on budget. It has seen the CoreWeave contract. Now it needs to see a successful ramp-up of that service. Another major catalyst will be the announcement of new funding. On October 7th, the company announced a funding milestone with Macquarie Asset Management, but building these AI factories is incredibly capital-intensive. The company's ability to secure favorable, non-dilutive financing to fund its build-out will be critical. And finally, watch the analyst ratings. We've already seen firms like Needham and Craig-Hallum raise their price targets in late October, citing the hyperscaler deal. As more of Wall Street abandons the crypto miner expectation and adopts the AI infrastructure reality, their models will be forced to re-rate the stock, likely to the upside. However, the risks here are just as significant. And this is where an online investment platform like Sophie Invest or Fidelity Investments gives you the tools to do your own research, which is essential. This is not a safe blue-chip stock like Apple stock. The first major risk is the balance sheet. Applied Digital is not profitable on a GAAP basis. It carries significant debt, and its liquidity is tight. This is a high-stakes construction and growth story. Any delays, cost overruns, or difficulty in accessing capital markets could be disastrous. The second risk is the sheer volatility. The stock has a beta reported to be over 6. This is an extraordinarily volatile instrument. It can drop 10% in a day for no reason. This is not a stock for an investor who doesn't check their Fidelity mobile app daily. It requires a strong stomach. There is also execution risk. The company is trying to scale at a massive speed, competing with established data center giants. Can they manage this hypergrowth effectively? And finally, there's the risk of insider selling. The company's CFO recently filed to sell a significant portion of his holdings. While this can be for many reasons, it's a data point that active investors on platforms like Interactive Brokers will be watching very closely. This is a company at a major crossroads, and its stock reflects that tension. Comment below with what you believe is the single biggest risk for APLD: execution, balance sheet debt, or competition. This pivot from crypto to AI is happening fast, and the market is struggling to keep up. To summarize, the expectation for APLD is that it's just another name in the volatile crypto mining basket. The reality is that it is an emerging AI infrastructure provider that is signing multi-billion-dollar long-term contracts with the biggest names in technology. The recent Q1 2026 earnings beat confirms this new reality is already taking root in the fundamentals. The stock's recent high-volume consolidation in the mid-30s is the market's attempt to digest this new identity. The path forward is not for the faint of heart. The financial risks are high, and the execution challenges are immense. But for investors who can separate the old false narrative from the new emerging reality, APLD represents one of the most compelling and the most volatile transformation stories on the market today. This isn't a bet on crypto. It's a bet on the very infrastructure that will power the next decade of artificial intelligence. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before